to today's Savant Live webinar. Thank you for joining us. In today's webinar, we're going to discuss, will Secure Act 2.0 impact your retirement? My name is Anne Mank. I am the Director of Financial Planning here at Savant Wealth Management. And today I am joined by Joe Marmorato.
Hi, Anne. Thank you for that. I'm glad to be here. And like Anne said, my name is Joe Marmorato. I'm a private client group planner here at Savant, and I've been in the financial services industry since 2012. And I'm excited to discuss how the Secure Act may impact retirement today. Let's dive in.
For our agenda for today, we're going to talk about four main topics. The first thing is just what is Secure Act 2.0 in general? What are some of the provisions? We're also going to discuss what the impact might be on some of the retirement accounts. We're also going to dive into the tax law changes and what that might look like for you and your retirement plans. And then we just have a brief section at the end for implications for small business owners. So with that, we will just go ahead and start with the Secure Act 2.0 provisions.
All right, so what is the Secure Act 2.0? Well, on December 29, 2022, just about a year ago, President Biden signed into law the Consolidated Appropriations Act of 2023. This was that $1.7 trillion omnibus spending bill that Congress passed late last year. Included in that bill was a major package of retirement savings provisions known as Secure Act 2.0. So this arrives nearly 3 years after its predecessor, the original Secure Act, which passed back in 2019 under the Trump administration. Secure Act 2.0 includes over 90 new retirement plan provisions. And just as a point of reference, the Secure Act 1.0 only included 29. So there's a lot of ground to cover here with Secure 2.0. It changes the way individuals save for retirement, and it changes several rules for retirees. And we're going to talk through a lot of those right now. So one of the biggest changes here is the required minimum distribution age increase. So before I talk about the rule change, I just want to highlight what an RMD, a required minimum distribution, is. That is when the government basically says you must begin withdrawing funds from certain tax-deferred retirement accounts once you attain a certain age. The reason being is the government wants you to enjoy your retirement funds for yourself when you are retired, and not use those funds to transfer onto other heirs and beneficiaries and use it as an estate planning vehicle. So previously, the RMD age was 72 under the Secure Act 1.0. It was actually age 70 and a half up until the Secure Act 1.0. So effective for this year, January 1st, 2023, the RMD age actually increased to 73. And then, effective January 1st, 2033, the RMD age increases to age 75. So you'll notice that Secure Act 2.0 includes various provisions that are going to become effective in various years. So this is a helpful chart below that we included saying, what is your RMD age? So for those born in 1950 or earlier, you have an RMD age of 72. For those born in 1951 to 1959, you have an RMD age of 73. And for those born in 1960 or later, you will have an RMD age of 75. Now, I do want to highlight one thing. Because this bill was rushed at the end of last year, Congress actually made a drafting error. So they are in the process of correcting it. And basically that said, if you were born in 1959, you have two RMD ages, age 73 and 75. They are fixing it to conform to this chart here. So if you were born in 1959, you have an RMD age of 73. All right, so we just talked about when the government forces you to take your retirement assets out. I want to highlight that once you attain age 59 and a half, you generally can take out distributions from your retirement accounts penalty-free. However, there are certain cases where an individual may need to withdraw their IRA funds prior to reaching age 59 and a half. And generally speaking, the IRS assesses a 10% penalty if you were to do so. But they came to the conclusion that there are certain situations where there should be exceptions, where you should be able to tap into those retirement accounts if needed. So I'm going to highlight a few here on this list, and these were new under Secure Act 2.0. The first one is a financial emergency. So you have a limit of $1,000 that you can distribute from a retirement account. You'll see here we have qualified plans. Those tend to be your employer-sponsored retirement plans, such as a 401k or a 403b. Then you have your IRAs, and that can include traditional IRAs, Roth IRAs, and so on. So this $1,000 limit that you are able to withdraw is effective next year in 2024. You're able to take that, and you're allowed to take a $1,000 withdrawal every 3 years so long as you eventually had paid that back. The next line item, pension-linked savings account. You'll notice that this one only applies to the qualified plans. That's because this is kind of tied to your 401k. So it's a $2,500 account that is tied to your 401k that allows you to take those funds out if needed. And it's basically a self-certification. If you say, I have a family emergency, I need these funds, you are entitled to take that out up to $2,500, effective in 2024. Some other exceptions they included here. If you're a victim of domestic abuse, you're entitled to take the lesser of $10,000 or 50% of the vested balance. That again is effective for 2024. You also have a terminal illness exception. So generally speaking, terminal illness meant if you were not going to live beyond 24 months, so 2 years. Secure Act 2.0 came out and extended that time period to 7 years. There is no limit on the amount you're able to take out penalty-free if you are deemed to be terminally ill. And you can take that from a qualified plan or an IRA, and that was effective this year in 2023. Two other items here. One is a federally declared disaster areas. That has a limit of $22,000. And interestingly, this one is retroactive to 2021 due to the various natural disasters that had occurred in 2021 up until now. And the final one is long-term care. So you're allowed a limit up to $2,500 to take funds from a retirement account, penalty-free, if you were to use those funds to pay for long-term care premiums. You'll notice that is only applicable to qualified plans, again, those 401ks, 403bs, and that is going to be effective come 2026.
And now we'll take a look at what the impact will be on your retirement accounts in general. And we'll start with the Roth 401k. So this one is trying to help the fact that there was a bit of a discrepancy. So in your 401k, you have the option of either contributing to a pre-tax or post-tax account. If it was after tax, it would go into your Roth 401k. Well, the way that the rules were set up, once you hit your required minimum age, you were required to take out of your Roth account. This is different than if you had a Roth IRA. In your Roth IRA, which is separate from your employer plan, you don't have a required minimum distribution. So what was happening is that individuals would have this after-tax money in these two buckets, your Roth 401k or your Roth IRA, and they had to take distributions once they hit a certain age in their 401k, but they didn't have to with the IRA. And so under the Secure Act 2.0, this has brought these two rules to be the same. So now if you have a Roth 401k, you do not have to take an amount out when you hit your required minimum distribution. You only have to take it out on that part that has not been taxed on. So just the more traditional part of the 401k. The next one that we look at is also a Roth provision. This one is talking about the Roth catch-up contributions. So in the past, we have not been able to contribute to your Roth when you do a catch-up. It would have to go into the 401k portion that is pre-tax. And so with the Secure Act, they said, yes, let's go ahead and let you put into the after-tax, but we are going to require you do this if you make $145,000 or more. And so this applies to your 401k, 403b, so those employer plans. What the IRS has done recently is push that back to 2026. So it was supposed to be effective 2024. We have now pushed it back to 2026. And one of the reasons for this is that not every plan has this Roth capability in it. So they want to make sure that the plans have the capability that if they're going to make sure, or if they're going to have individuals contribute to this plan, they want to make sure that it's there. So once again, this has been delayed to 2026, so we'll give you more information as we know in the future. The next one is the 401k contribution increase for the catch-up. So we're going to do some math here. Right now, there is a catch-up contribution. It's $7,500. So if you're over 50 years old, you are able to put an additional amount into your 401k. Well, as planners, we want to make sure that individuals can get to retirement with enough funding. And so one of the things that the IRS was noticing is that individuals that are closer to retirement age are wanting to put more in. And there might be a reason for this. Maybe they no longer have a mortgage payment. Maybe they were paying college education and they no longer have that. So they might have some additional cash flow when they get closer to retirement. So what they're allowing to do is at the ages of 60, 61, 62, and 63, you are able to make a larger catch-up contribution than the regular contribution of $7,500. So in 2025, this is going to be 150% of the regular catch-up. So on this last part on the right-hand side, you can see that in 2024, if the regular catch-up was $7,500, this means in 2025 that the individuals in this age range will actually be able to put into their account an additional $11,250 versus the $7,500 that they have been able to do in the past. And since we are on the theme for catch-up contributions, you can see that the IRS was really paying attention to this part of the saving for retirement. But for this, what they are allowing to do is index the amount that you can do for an IRA catch-up contribution going forward. So in the past, it's been $1,000. It has not changed since 2006. So that's been a long time where we haven't seen any adjustments. And now what they're saying is that they are allowing this $1,000 amount to be indexed to inflation. However, unfortunately for 2024, we are keeping it at $1,000. I shouldn't say we. The IRS is keeping it at $1,000. And when they do the incremental increases, it actually is going to be a small amount. So just for reference, the regular amount that individuals can put into an IRA for 2024 is $7,000. And then if they are 50 or older, they can put an additional $1,000 into their accounts.
All right. Thank you, Anne. Now we're going to talk about some tax law changes here under the Secure Act 2.0. Okay, so we are going to start off here with qualified charitable distributions, also known as QCDs. So what is a qualified charitable distribution? Well, a qualified charitable distribution allows individuals age 70 and a half and over to donate up to $100,000 directly to a qualified charity from an individual retirement account. You'll notice it's age 70 and a half. That ties back to that original required minimum distribution age back in the day. The IRS did not change this with regard to QCD, so that age still remains at 70 and a half. So Secure 2.0 now annually indexes this $100,000 limit for inflation. So just as Anne covered some inflation adjustments on the catch-up contributions, Congress is also applying it to other various provisions here. So beginning in 2024, this amount will now increase to $105,000. First time ever that this has increased here. Now, qualified charitable distributions are a beneficial giving strategy. They can be used to help satisfy your required minimum distribution for the year and reduce taxable income. So for example, if you were to take a distribution from a traditional retirement account, generally speaking, that is considered taxable income. If you were to elect a QCD and give that money directly to a charity, you are not required to recognize that as taxable income for federal purposes. So it can help reduce your tax liability. Generally, QCDs can be more beneficial than giving charitable deductions and claiming an itemized deduction. I'm not going to get into all of that. But these QCDs are definitely a beneficial strategy. I also want to highlight that Secure 2.0 also allows for a one-time QCD up to $50,000 to a charitable remainder unit trust, a charitable remainder annuity trust, or a charitable gift annuity. Now, there are certain rules around that. I'm not going to get into those during this presentation, but that definitely is a new provision here under Secure 2.0 that some individuals will look to take advantage of. Okay, and now one of the most significant provisions, in my opinion, that I've seen floating around the news here when Secure 2.0 came about, and that is a 529 plan rollover to a Roth IRA. So first, I want to touch on what is a 529 plan. Well, a 529 plan is an investment account that allows families to save for a beneficiary's future education. There are tax advantages with certain 529 plans. Generally speaking, the earnings can grow tax deferred and can even be tax-free if those funds are used for qualified tuition and educational purposes. So when an individual graduates and they still have remaining funds in their 529, you have a couple of options here. You can either save those funds for future use if you anticipate going back to school and getting more education there. Under Secure 1.0, you can also now pay down some of your student loans. So that's a nice benefit. You can also transfer the funds to another beneficiary, or you can distribute the funds for non-educational purposes, but you will likely be subject to a penalty there. So Secure 2.0 offers another option here. So on the blue section, Secure 2.0 will allow leftover 529 funds to be rolled over tax-free to a Roth IRA under the following conditions, and there are many. The account must have existed for at least 15 years, likely with the same owner, likely with the same designated beneficiary, and likely in the same 529 plan. Now, why am I saying likely? So as I mentioned before, Congress had rushed through this bill, passed it, and now it is law. And the IRS still needs to interpret what exactly Congress was getting at. So this provision here is supposed to take effect in 2024. For other provisions in Secure 2.0, the IRS has already come out and give us some guidance. They delayed some, as Anne just said. Other ones, they provided more clarity. Interestingly, they have not come out and said anything about this. And this is supposed to be effective in just about 10 days here. So the IRS could very likely have a different interpretation, so there are still some gray areas around this. So likely the allowance to do this is going to vary by custodian early on in 2024 until we get more guidance. So some other conditions that must be met here. Contributions that are made within the last 5 years don't qualify for a rollover. The annual rollover that you are able to do from a 529 to a Roth IRA is limited to the current year Roth IRA contribution limit. So for 2024, this amount is $7,000. The next line item, total lifetime rollovers per beneficiary cannot exceed $35,000. So if the limit were always to say it's $7,000 a year, that essentially gives you 5 years that an individual could roll over their funds from a 529 into a Roth IRA. So this will be very beneficial for those beneficiaries as they're able to help fund their retirement accounts for future years. Now, other Roth IRA rules appear to still be applicable, where the individual will still need earned income in order to be able to even contribute to a Roth IRA. They also have the Roth IRA 5-year holding rules in order to take distributions penalty and interest-free. You also have the age 59 and a half exception for more penalty-free withdrawals as well. Now, there is one caveat here, and that's down at the bottom, is that some states may not consider this to be a tax-free rollover. So granted, while the IRS may say it is okay, your state of residence may not, and they may tax you on that rollover there. Okay, so now we're also going to be talking about some inherited retirement account distribution rule updates. And now I'm backtracking a bit and going back to that Secure Act 1.0. And the reason I want to talk about this is because the IRS came out recently with an announcement, and it's going to impact some rules around Secure Act regulations here that we think are very important to relay to everybody. So under the original Secure Act, Congress eliminated the stretch IRA. So what does that mean? Well, under the old rules, beneficiaries of retirement accounts were allowed to take annual RMDs based on their own life expectancy and effectively stretch those distributions over their own lifetime, allowing the account to grow tax deferred for decades. So for instance, if a grandparent were to pass away and leave their retirement account to a grandchild, that grandchild who say is 18 years old can take distributions for the remainder of their life out of the account. So they're able to use it as a wealth transfer strategy, essentially. So in that bottom bucket there, you'll see Congress determined again that retirement accounts should be used for the benefit of the retiree and not for estate planning purposes to transfer wealth to other beneficiaries. So Congress came in and implemented some stricter rules. So they basically broke individuals out into two separate categories here. The first category we're going to talk about is an eligible designated beneficiary. Another acronym here, we have EDBs. So these beneficiaries qualify for the stretch IRA, okay? So what does this mean to be an eligible designated beneficiary? Well, surviving spouses qualify. They are still able to stretch distributions over their life expectancy. They're also entitled to other options as well, which I'll get into in a minute. Minor children of the account owner up until age 21. Previously, this used to be age 26 and varied by state, but the IRS came out and said it is age 21, and this provision does not include grandchildren. You also have disabled individuals, chronically ill individuals, and individuals who are not more than 10 years younger than the IRA owner. So that could be siblings close in age or unmarried partners. So all of these individuals here are still able to stretch those distributions out and enjoy many, many years of tax-deferred growth. So now, for all other individuals, they are going to be subject to this 10-year rule that you may have heard about. So again, under the original Secure Act, there is a new 10-year payout rule required for individuals considered to be non-eligible designated beneficiaries. So these are essentially adult children or grandchildren. So Congress said, if you were to inherit an account and be a non-eligible designated beneficiary, you must liquidate the account by the end of the 10th calendar year after the year of death. So it seems pretty simple and straightforward. And now I'm getting back to my point before where the IRS needs to provide clarity. Because what happened was Congress passed this bill. Everyone was under the understanding that, hey, I now just have to liquidate the account by the end of the 10th year after the year of death. Well, the IRS came out and added something to it. What they said was, if the original owner was subject to required minimum distributions, then the beneficiary must also take annual distributions based on their own life expectancy for years 1 through 9, with a full distribution in year 10. So they're complicating it greatly here. They also said if the original owner was not subject to RMDs, then the beneficiary does not have an RMD requirement, but they still must liquidate the account in year 10. So the IRS interpretation of Congress's law definitely added some complexity here. So why are we talking about this now in the Secure 2.0 presentation? I'll mention that on the next slide. This summer, IRS issued Notice 2023-54 and basically said, these rules are very complicated. They are brand new. We are going to waive the penalties for any missed RMDs for inherited IRAs for the 2023 tax year, only for those individuals subject to that 10-year rule. So I want to highlight here that these penalties were also waived for tax years 2021 and 2022 as well, specifically by the IRS. They were also technically waived for 2020, but that was due to COVID relief regulations. So I want to mention these rules are still expected to be effective beginning with the 2024 tax year, unless the IRS changes them again. So we are still waiting on final guidance from the IRS. It has been now 3 years essentially since the original Secure Act came out, and we are still waiting on final answers for this. But as everything currently stands, there are no required minimum distribution for 2023 for those subject to the 10-year rule. If you are an eligible designated beneficiary, remember, if you are a spouse, a minor child, you still may have a required minimum distribution for 2023. The IRS only waived it for those subject to that 10-year rule. All right, so under Secure 2.0, they also added additional distribution rule flexibility here. So this one gets a little detailed. I'm going to try to stay as high level as possible here, but I want to mention this because it's a new option available to surviving spouses. So currently, if a surviving spouse inherits a retirement account from a deceased spouse, they can either roll the IRA into their own and complete what is known as a spousal rollover. You can elect to treat the decedent's IRA as your own and basically just take full ownership of it. Or you can elect to remain a beneficiary and take distributions based on your own life expectancy. Remember that eligible designated beneficiary that we just covered. Now, as a spouse, you can make an election to defer the required minimum distributions until the deceased spouse would have reached their required beginning date. Required beginning date just means the date that they were subject to RMDs, and that's technically April 1st of the year after you turn that RMD age. So as a beneficiary, you can use a single life expectancy, which is less favorable with the surviving spouse's life expectancy. So these distributions can be large, and Congress realized that, so they wanted to offer another option to surviving spouses. So what Secure 2.0 did was, beginning in 2024, Secure 2.0 is going to allow the surviving spouse to use the deceased spouse's distribution rule. So it's as though they get to act as though they are the deceased spouse. So again, first bullet point, for RMDs for the surviving spouse would be delayed until the deceased spouse would have reached their RMD age, right? So similar to what we just covered. However, once that deceased spouse reaches their required beginning date, the surviving spouse can calculate RMDs using a more preferential table with the decedent's life expectancy. So this is a bit confusing, I imagine. So why is this important? When does this actually come into play, and when would somebody use this? So looking at the box on the right, this is primarily important for surviving spouses who inherit retirement accounts from a younger spouse. So by treating themselves as the decedent, they can delay these taxable RMDs longer, and then they can take smaller taxable distributions than if they completed a spousal rollover or made that original election on the previous screen. So all in all, there's a lot of options available to surviving spouses. So it's definitely important to speak with someone qualified in the area, a financial advisor, to learn more about these rules and determine what may be most appropriate for you.
Thanks, Joe. I know, even being in the planning department, even for us to try and figure out how everything comes together when it comes to RMDs, when it comes to the beneficiaries, when it comes to inheriting these accounts, whether you're a spouse or not, it can be very complicated and hard to follow. So the IRS has not simplified it for us, but they're supposed to come out with some additional clarification, like you said, about what we're going to do for 2024. So the next section that we're going to look at are implications for small business owners. And so there's just a couple of points here that we wanted to walk through with you to make sure that you understand, if you are a small business owner or if you work for a small business owner, how this might impact some of your retirement accounts. So the first change that we noted is that the simple and SEP Roth contributions. So in the past, when there is a simple or SEP contribution, it was only in pre-tax funds. They were not allowed to put anything in post-tax, so that Roth contribution. And so we know that this is likely going to take some time for employers and custodians to implement this. So it's not beginning in 2023, but it will take some time for this to be implemented to that small business owners. But it is another option for those individuals who work for those smaller companies. And then beginning in 2025, they will also have that catch up of 150% of that regular catch up. So in 2025, it will be $5,000 or that 150,000 of the regular, whichever is greater. So a small change, but it could have a big impact in retirement planning for those with businesses. The next one is the solo 401k. So a solo 401k is an option for business owners who are either solopreneurs, they're the only individual there. They might have their spouse working for them. They might have employees, but they're seasonal, part-time, or subcontractors, so not really considered full-time employees for them. And they have this option of being able to put this solo 401k together. So it might be a valuable benefit for them to be able to do. However, there was a disconnect between when this 401k needed to be adopted and when they were funding these plans. So in the past, you had to have this plan in place before the end of the calendar year, so December 31st, but you were able to fund it all the way to April 15th. Well, as a business owner, you might not know what your revenue is going to look like, how much you have available from a cash flow perspective to be able to fund the 401k. So there were a lot of unknowns. So what the IRS has done is said, okay, we are going to make sure that these two dates are the same. So for plan years beginning in 2023, the deadline for both adopting this type of plan and for contributing to it will now be April 15th. The next one that I did want to go through as well is really beneficial for those that are starting out in their career. So it's an automatic enrollment in employer-sponsored plans. So the big thing with this is it does not change any plans that are already in place. This would be only for those that are new beginning in 2025. But what it will do is it will default to enroll their employees into the employer plan at an amount of 3% or higher, up to 10%. So the employee will actually have to opt out of the employer plan versus opting in. And then each year after that, that contribution will increase by 1% till it gets to 10%, but it can't go over the 15%. And there are some exceptions here, like I mentioned, that if you already have a plan, it's grandfathered. You do not have to do this automatic enrollment. But also if you're a small business of 10 or fewer employees, or there are some church and governmental plans as well. But there was a study done by Vanguard that noted for defined contributions, which already have a lot of these automatic enrollments in it, 92% of participants are still participating in the plan 3 years later. And so what they're trying to do is, it's just human nature that it's hard to go ahead and enroll. You ask me to go ahead and click this link and figure out how much I want to put in and, when do I want it to start? I most likely will stop somewhere along the process. But if you do it for me automatically and make it easy so that I don't have to make a lot of decisions along the way, I am more likely to be able to follow through and then stay with the plan. So this will be a great benefit for those that are starting out and are new. The next one, which also benefits those that are starting out in their career, is the matching contributions for student loan payments. And what the IRS was seeing in the industry is that those that are coming into the workforce had a large amount of student loans. So we've seen that in the news, that they have a burden of student loans that they are trying to pay back. So these individuals are trying to make the decision of, do I put money into my 401k for the future, or do I pay down my student loans? And a lot of individuals were saying for them, it was better to pay off these student loans. But then what was happening is they were missing out on the matching contribution that the employer was offering. And so this new regulation allows employers to match based on what the individual has put away on their student loan. So they don't have to be contributing into the 401k in order to get this match. The employee can certify that they had paid a certain amount of loans, and then the employer is able to match on whatever that employee has certified. But the other important part of this is that employers are not required to offer this feature. So it is a nice feature, especially if you're trying to get younger employees in, or you're more of a company where you really like to have people right out of school. So, in the financial industry, what we tend to do is hire individuals out of school, and then they work within a group. We have a financial advisor that will help them along the way. And then eventually they become a financial advisor and have their own clients that they work with. And so for those types of businesses, having this opportunity to be able to provide this benefit for their employees might make a difference on whether they decide to go with their company or not. But either way, like I said, employees are not required. It's just an additional benefit for those that are paying on student loans. And then the next one, I'll have Joe kind of talk about what does the future hold. But as he's talking, or towards the end here, feel free to put any questions that you might have in the Q&A section, and we'll try and get to as many as we can at the end of this presentation. So Joe, what does the future hold?
Sure. Thanks, Anne. So Secure 2.0 addressed a lot here, and we only covered some of the main focal points here, the main provisions that we think are very important. So what does the future hold? Will we see additional changes? Well, starting off, will we see a year-end tax package, right? That's always a question that comes up. At this point in time, the answer is likely not. Congress, the House of Representatives, is already out on recess. I believe the Senate is still working on finishing up some work here, but we are not expected to see any major tax changes this year. It's possible that they will tack on some tax provisions onto the budgets that are going to be worked on early January and February. There are rumors that if they were to address any tax provisions, they would look to extend some certain business tax deductions and also possibly increase the child tax credit. But again, nothing too significant. So that goes into what hasn't been addressed here in Secure 1.0 or 2.0. Will we see a Secure Act 3.0? At this point, we are not sure. There's no word that they are working on another retirement package at this time. However, I do imagine that Congress will likely work on something in the foreseeable future here. So Congress did not address certain provisions that many people thought they were going to tackle here, such as there are no changes to the backdoor Roth IRA. This is still allowed. Congress did not implement any restrictions on Roth IRA conversions and income limits and so on. It's very possible they'll look to address this in the future, but as of right now, that is very unknown. And finally, one of the most important tax law changes coming up. Will the current individual tax code sunset at the end of 2025? That basically means expire. So under the Tax Cuts and Jobs Act signed in by President Trump, these rules for individuals were set to revert back to the previous tax law. So the 2017 tax law, which will result in higher tax rates for many individuals. Now, that is really going to be dependent upon who is in Congress, who is in the White House in 2024. So at this point in time, it's anyone's best guess, but I'm sure we'll have a lot more clarity on this at this point next year.
Perfect. So even with, a lot of that, what we discussed, we admit it's very high level, but we wanted to give you some of the key points as we're talking about the Secure Act 2.0. But if you need to get some additional information, if you would like to talk to an advisor, feel free to click in the link in the chat to schedule that 15-minute intro call. So now at this point, we'll take some questions that we've been able to have along the way. And if we don't get to your answers and there is something you'd want to know, schedule that call and we're happy to answer that for you. So there was a question that was talking about the waiver, so that RMD waiver for the penalty. And the question was, how does that affect that 10-year time frame, if at all? So for example, because we've said, or the IRS has said, that we don't need to do an RMD withdrawal. And actually, they never even said that you don't need to do the RMD withdrawal. What they said was that there is no penalty for not doing that. So since they waived this penalty for not having the RMD for that 10-year, does that extend that 10-year period?
So I'll jump in here, and the answer is no. Those waivers do not extend that 10-year window. So while it provides initial relief for that current tax year, you are still required to liquidate within that 10 years. There is no extension, unfortunately.
And as long as we're talking about RMDs, part of this, which we didn't bring up, but as we're talking about waivers, was the penalty itself. So part of the secure, when we're talking about 1.0 and 2.0, one of the things that they did change was what that penalty would be. Joe, can you speak on that? Otherwise, I'm happy to speak on how that changed.
Sure, the missed RMD penalties?
Yes. Yep.
Yes. So back in the day, it was a very large 50% penalty if you failed to take your RMD. Now, the IRS was very lenient, and you were able to kind of request an abatement of that penalty, a waiver in essence. So Congress realized that that is a substantial penalty that's going to eat into a lot of people's retirement accounts if they fail to take that. So under Secure 2.0, which we did not address in the presentation, Congress actually brought that 50% threshold down to 25%. So it is now a flat 25%. However, they also added something where that penalty will be brought further down to 10% if timely corrected. Timely corrected generally means within 3 years. Now, what's interesting is, as I said, when it was a 50% penalty, the IRS was very lenient in granting relief to taxpayers. However, now that they brought these penalties down, it's unclear if the IRS is still going to be as generous as they once were, or if they are in fact going to impose these penalties of 25% or 10% on taxpayers. It's still too new to really understand and see how this is going to play out, but we should know as time goes on and how the IRS handles this.
Perfect. And the last question that we'll cover too is that 529 to IRA rollover. Can you just go through it again of just verifying when this starts? So what year can you start doing this? But then can you give an example of what that might look like? If somebody is sitting with a 529 plan, when would this kind of come top of mind, or when should somebody start thinking about this?
Yes. So this 529 plan rule is supposed to take effect in 2024. So very, very soon. So it's understood at this time that those 2024 contributions can be rolled over. So an individual who may have graduated and has remaining funds in a 529 plan can use those funds for consecutive years here to roll those into a retirement account. If they know that they are not going to need to access those funds for qualified educational purposes, and they believe that they would be better suited for their own personal retirement at a later date. That is when you'd want to consider converting those funds into a Roth IRA.
Perfect. And, part of this too, like you were mentioning, and what we're all grappling with is, does it need to be in the same plan? How many years? If somebody, and a good example of this is, I have multiple children. So if I have a 529 and one beneficiary is for my oldest and there's still money left over when she's done with school, I change the beneficiary to my youngest and we use that for school. And if there's money left over, now who gets this into the 529 rollover? So there's a lot of questions that still need to be answered for that. So stay tuned, but keep on top of what you're hearing in the news. Reach out to your financial advisor if you have any other questions. And so with that, I just want to thank everyone for participating in today's webinar. We hope we were able to provide at least some information so that you have a better understanding of what the Secure Act 2.0 really is about and how it might affect you. And Joe, I wanted to thank you for participating and helping me with this as well.
Thank you very much, Anne. I hope everyone learned something today, and I appreciate everyone's attendance. Thank you very much.